Let's begin with the foundations. Welcome to another lecture. Today we will explore the multifaceted career of Joshua Kushner, investor, operator, and increasingly a figure at the intersection of technology, healthcare, media, and sports. I am Alexei. I teach and study the ways capital allocation shapes real enterprises. In this context, our subject offers a compact case study of modern influence networks and their consequences.
Hi, I am Priyanka. I help with research and questions, and I am here to push us on the points that students usually find confusing or interesting.
To frame our discussion, it is important to understand who Joshua Kushner is in the written record. He is an American businessman and venture capitalist, founder and managing partner of Thrive Capital in 2009, and co-founder as well as vice chairman of Oscar Health since 2012. He has operated as what we might call an operator investor, straddling the governance of his own ventures and the cultivation of others, from Instagram and consumer networks to Perfortune in 2024, OpenAI in frontier artificial intelligence. Let's clarify two terms that recur. Venture capital refers to private investment into early and growth stage companies in exchange for equity, with the ambition of outsized returns relative to risk. An IPO, or initial public offering, is the first sale of a company's shares to the public on a stock exchange. It converts private paper into liquid market value and submits the firm to disclosure regimes that arguably discipline strategy and capital allocation.
So, basically, we are following capital from thesis to execution and then to public accountability. That helps me, thank you.
Why does this matter? The ventures in question have touched everyday life at scale. Instagram shaped visual culture and distribution economics for creators and advertisers. Oscar Health attempted to simplify a regulated, low-margin industry that most citizens meet at stressful moments. Thrive's participation in AI companies signals influence over technologies whose externalities may be systemic. Historically, the role of venture capital in growth is both catalytic and to some extent misunderstood. We often romanticize ingenuity while underestimating governance, capital costs, and the ethical guardrails that keep experimentation from becoming exploitation. This then brings us to a compact history. Joshua Kushner was born in 1985 in Livingston, New Jersey, and educated at Harvard College, graduating in 2008, followed by Harvard Business School in 2011. He tried media early at Harvard with a pop culture publication called Scene. Reception was mixed, but the media impulse would resurface later. In 2007, he co-founded Vostu, a social network oriented to Latin America and non-English dominant markets, a thesis about underserved digital communities. In 2008-2009, he worked with Goldman Sachs on distressed debt, which is a useful apprenticeship for understanding capital structure under stress. In 2009, he founded Thrive Capital, initially focused on media and internet, and in the same period co-founded UniThrive, a peer-to-peer alumni microloan platform modeled on Kiva. Small interest-free loans up to $2,000 with the expectation of repayment after graduation. Thrive then scaled in sequential funds, 2011 at $40 million, 2012 at $150 million, 2014 at $400 million, 2016 at $700 million, 2018 at $1 billion, 2021 at $2 billion, 2022 at $3 billion, and in 2024 at $5 billion. Along the way, Thrive made a concentrated early bet on Instagram's Series B. When Facebook acquired Instagram, Thrive reportedly doubled its money quickly, a canonical venture calling card. He co-founded Oscar Health in 2012, which reached a $2.7 billion private valuation by 2016, and went public in 2021. However, its first quarter as a public company included an $87 million loss, illustrating the structural difficulty of profitable insurance innovation. We should also note adjacent activities. In real estate, he and his brother Jared each own 50% of JK2, also known as Westminster Management. In April 2021, a Maryland judge found widespread consumer protection violations at Baltimore area properties. In 2015, he co-founded Cadre with Jared Kushner and Ryan Williams. Beyond real estate and fintech, he is engaged in sports and media. In 2021, Goldman Sachs reportedly invested in Thrive at a $3.6 billion valuation, and Joshua sold a 3.3% stake in Thrive to a group including Bob Iger and Henry Kravis, valuing the firm at $5.3 billion. In sports, he acquired 2.5% of the Memphis Grizzlies in 2019, sold that stake when he bought into the Miami Heat in 2024, and in August 2026, it was reported that he and Bob Iger purchased the Los Angeles Lakers for $12.5 billion. In media, with Carly Kloss, he co-founded Bedford Media, moving to revive Life magazine in early 2025. And in 2024, he joined the board of A24 Films. Also in 2024, Fortune listed him among the 100 most powerful in business, citing Thrive's early OpenAI investment.
That's a lot of surface area across sectors, and reputational risk too. It makes the trade-offs very concrete.
Speaking of trade-offs, my own interest lies precisely in that intersection, where sleek software meets stubborn institutions. Healthcare does not behave like photo sharing. Capital is necessary but insufficient. The math of medical loss ratios and compliance can defeat even elegant product design. Perhaps this is why I find the case instructive. It is, if you will, an applied seminar in constraints. Moving forward, let us organize our inquiry around three questions. A historical one about early strategic choices, a counterfactual concerning COVID-era infrastructure, and a present-day question about investing in frontier AI under uncertainty.
Professor Alexei, may I ask the historical one first? How did the Latin American market shape Kushner's early business strategy with Vostu?
We observe an explicit thesis. Growth in non-English dominant internet populations created room outside the gravitational pull of US platforms. Strategically, this is market selection by linguistic and cultural segmentation. It aims to arbitrage attention where incumbents are weak. The choice also signaled comfort with cross-border operations, local network effects, and monetization in economies with different payments rails and ad markets. The challenges were formidable. Distribution modes form quickly and social, local legal regimes vary, and product differentiation must be more than translation. It must be cultural fit. In simpler terms, the plan was rational, and the execution environment was hostile and fast-moving.
And the lawsuit. Professor, could you clarify how the copyright case affected Vostu's retrenchment?
In 2013, after a competitor's copyright lawsuit accusing game copying, Vostu laid off most employees and scaled back. The layoffs and retrenchment are documented. The copying claims remain allegations in the materials we have, not adjudicated findings here. Causality is therefore nuanced. Litigation pressure and competitive dynamics likely interacted, And arguably, the episode exposed how fragile a social gaming business can be when legal risk and platform dependence compound at once.
Building on that, the counterfactual. Professor, what if Oscar Health's COVID testing website had actually launched nationwide?
The Atlantic reported that Jared Kushner had contracted Oscar to develop such a site, which was later scrapped. If we imagine national deployment, the immediate effect could have been reputational. Oscar as a competent executor of urgent federal and state logistics. That might have lowered customer acquisition costs in subsequent enrollment cycles and strengthened regulator rapport. However, the financial engine in insurance is medical loss ratio and risk adjustment. A testing portal alone does not bend those curves decisively. So we can infer limited direct P&L impact, but meaningful brand and trust dividends that could have improved the company's post-IPO narrative and perhaps capital market tolerance for early losses.
And for public health, I think the question is whether such a tool would have changed outcome.
Potentially, yes, at the margin. A unified interface for scheduling and routing can reduce friction, reveal capacity constraints, and prioritize vulnerable populations when coupled with good data. But public health is a systems problem. Supply chains, laboratory throughput, state-level policies, and trust in institutions all mediate impact. A national portal might have accelerated triage and transparency. It would not by itself have replaced the hard work of coordination. Ethically, one must also account for privacy, data governance, and the optics of a politically connected firm stewarding sensitive health information.
To shift gears a bit, Professor Alexei, what are the current challenges Thrive faces in AI investments, especially given the OpenAI exposure?
Several constraints are salient. First, capital intensity and supply chain concentration. Frontier model training requires scarce compute, often controlled by a few hyperscalers. Investor returns thus sit downstream of vendor pricing and geopolitics of chips. Second, moat ambiguity. In an environment of rapid open source progress and model commoditization, defensibility may migrate to data rights, distribution, and compliance integration rather than to raw model quality. Third, governance complexity. Labs with novel structures or capped profit models test conventional venture rights. Board crises and mission ambiguity can propagate portfolio risk. Fourth, externalities and regulation. Dual-use risks, safety incidents, and emerging AI liability regimes imply that value creation must be paired with auditability and incident response. Finally, concentration risk. A small number of platforms may drive correlated outcomes. Funds must balance participation in category leaders with exposure to durable application layers and tooling.
What if we thought about it like this? Future research directions could help investors price risk better. What would you prioritize?
It is worth noting a few frontiers. We need standardized model evaluation suites that correlate with downstream safety and reliability, not just benchmarks. Think of it as a credit score for models with stress tests. Compute accountability and audit rights, including transparency into training data provenance, will become term sheet items. Sector-specific compliance scaffolding, HIPAA, SOX, GDPR-like regimes, should be treated as product features, not afterthoughts. Energy and latency externalities must be priced into unit economics, otherwise margins will be illusory. Finally, we should build institutional capacity for red teaming, incident reporting, and third-party audits, ideally via cross-industry standards bodies. In simpler terms, governance must scale as fast as capability. To summarize, Joshua Kushner is a venture capitalist and entrepreneur who built Thrive Capital from 2009 into multi-billion-dollar funds, co-founded Oscar Health, which went public in 2021 amid difficult unit economics, and extended his reach into media and sports, including the reported August 2026 Lakers acquisition with Bob Iger. Our three inquiries traced early market selection in Latin America and its legal competitive pressures, a COVID-era counterfactual, where a national testing portal might have yielded trust dividends more than profit, and today's AI investing challenges, where governance, compute, and ethics are as decisive as code. For those who wish to continue, examining the role of venture capital in explicitly social enterprises would be a natural sequel, where impact metrics and fiduciary duty meet. This then completes our present analysis. Thank you for listening, and I encourage you to keep interrogating how capital and code shape the institutions we live inside.
Thank you, Professor. And thank you all for joining us today. So, I guess that kind of sums it up. Until next time.